Risk is the possibility of loss of some or all of the original investment, but it is wrongly associated with only capital loss. Risk is also the possibility that returns are less than expected. Inflation risk is the risk that the investment's cash flow won't be worth as much in the future because of decrease in purchasing power. Inflation risk is high in fixed instruments with locked-in cash flows. It is a cause of concern for retired individuals. If due to increasing inflation, their committed cash flow is inadequate. Liquidity risk is a risk that the investor may not be able to convert an asset into cash when desired, or the asset needs to be sold below its intrinsic value. To manage this risk, investors need to set aside a portion of their portfolio in cash or marketable securities. Credit risk is the risk of default by the borrower. It is mandatory for borrowers to share their credit rating with investors. A high credit rating, such as AAA rating, reflects positively on the borrower's capacity to service interest and principal payments. Government issued securities have no credit risk. Other borrowers carry varying degrees of risk. Reinvestment risk is a risk where proceeds from principal and interest payments have to be reinvested at a lower rate. If interest rate rises, investment risk is eliminated. If interest rate falls, the risk increases. Business risk is specific to operations of a company. Examples of currency risk would be where a deposit in dollars fetch lower returns because of depreciation of dollars against the rupee. In this situation, every dollar will fetch less number of rupees when the deposit matures. We have covered interest rate risk throughout the course. It is a risk where the price of a bond fluctuates with changes in interest rates. It is important to note the inverse relationship between interest rates and bond prices. If interest rates increase, price of a purchased bond will decrease. Market risk is the risk that the entire market or an asset class faces. This is not diversifiable. It is also called systematic risk. Examples of market risk are exchange rate risk, interest rate risk. Unsystematic risk is specific to a particular security. For example, credit risk, business risk, liquidity risk. It can be diversified by adding other assets.